This is Brent with Black Lion Capital Management and the U.S. Petroleum Report for Wednesday, February 24, 2016, featuring Update Analytics, incorporating data from the Update Energy Feed, the Energy Information Administration, Baker Hughes, and CME Group NYMEX. Highlights from this week's report: another production decrease at a century-low total rig count. Commercial crude oil added over 3.5 million barrels to set a new record. Cushing, Oklahoma is at a new record. However, gasoline, ULS diesel, and total petroleum all had a drawdown. Let's go to the charts. Beginning with U.S. continental production for the lower 48 United States, down to 8.6 million barrels per day. Drew this dashed line on the chart last week just to show that we'd taken out a new low set previously in 2015. It does appear that the decreased exploration and production activity is beginning to have the desired effect on production in the lower 48. Total petroleum production, this is for all U.S. fields, including Alaska, down at 9.1 million barrels. And very close to where we were previously in 2015. Commercial crude oil storage up to a record of a little over 507 million barrels following the 3.5 million barrel addition, well above the 491 previously set back in 2015 and tested again. The seasonal comparison for commercial crude oil. In the top pane we look at 12 to 14 months of commercial crude oil storage, add a 10-year average of storage for each week. That's the silver dashed line in the top pane. Take the delta between the two and represent that as either a surplus or deficit on the green bar graph in the bottom pane. Very easy to do in Update Analytics. And you can see this week we have a 187 million barrel surplus consistent with that new commercial crude oil storage record. Cushing, Oklahoma is the physical delivery point for NYMEX light sweet crude oil futures and sets a new record this week at 65.1 million barrels in storage, following just an addition of over 300,000 barrels. Total petroleum storage actually backs off this week. Mentioned this at the top of the report. Historically, as you can see, that ever since it broke above its previous multi-year record there in 2014, that almost every week it sets a new record, but this week it backed off 5 million barrels. Exploration and production activity, as measured by the Baker Hughes rig count, continues to decline. This is rotary rigs in the United States only, focused on exploring for oil, down to 413 after stacking out 26 rigs last week. That's represented there on the delta in the bottom pane. In the top pane, I've drawn the brown horizontal dash line back, and you see we have to go all the way back to December of 2009 to find a similar level of activity. The total rig count, this is all rotary rigs in North America, so this includes Canada and rigs exploring for natural gas as well. Down 27 to 487 rigs. Follow that brown dash line back, and it takes us all the way back to July of 1999 to find a similar low level of activity. The all-time record low is 392. That's the red dashed line in the top pane. And it's very easy to imagine at the current trend that we could test or even decline below that. This is the seasonal chart for NYMEX light sweet crude oil futures. The top pane is NYMEX light sweet crude oil futures. This is the continuous contract from the Update Energy Feed, so this is roll adjusted. And the bottom pane we have the 10-year weighted average of annual seasonality. And as you notice each year, here in 2014, from end of February through April, we have a very strong seasonal demand. That happened again in 2015, and we're in similar circumstances in 2016, and we have seen some support for NYMEX light sweet crude oil. This is the daily cloud chart that we look at each week. Still very little to be bearish about. In fact, almost nothing to be bearish about. Things that we look at on this chart initially when we just look at a glance is that both the price and the heavy blue lagging line are well below the clouds. The cloud spans are negative, indicated by the pink color. The green turning line below the purple standard line. However, the price has transitioned above the turning line this week. I've added some dash lines as well that just because we tested the $26 level, actually specifically $26.12. We tested it twice and looked at where some of the overhead resistance was, and that comes in at about $34.15, which roughly correlates to the top of this cloud. where if we were to get some kind of trend reversal, we'd want to see this blue lagging line above that level, and that right now is at about $34.80. So this level over $34 bears watching. If you follow CNBC or Bloomberg, you've probably seen some articles, some technical analysts on there that have mentioned this level as well. So we've got it highlighted on the chart to follow it. And of course on up data, if you want to see the point and figure representation, very valuable. Shift and T on your system, and you will draw a. You can draw the chart. It'll automatically come up. I've got mine set for a 1% logarithmic chart, 3-box reversal, similar to what we saw on the daily chart. We're well below bearish resistance. We do still have several downside targets, and we need to keep an eye on this anytime we're working below bearish resistance. $15.43, $13.29, but before those come into play, we need to realize this $24 target. That is below the 26 level that we highlighted on the daily cloud chart, and we'll look again here shortly. Only one active upside target, $41. Right now. So again, it's still a bearish picture. That $34 level is out there. We're going to keep an eye on that, and we are in a time of seasonal strength. We're roughly halfway through it, but still very hard to fundamentally make a case that we're going to break out of that and go higher anytime soon. The 60-minute point and figure chart. This is still that this is still the continuous contract. Only this time the data coming to you from eSignal. Interactive data. So with Up Data Analytics, you can incorporate data from many different sources into a single analysis tool. Very powerful. Again, I've drawn the blue dashed lines here that roughly correspond to where that overhead resistance is on the daily chart. $34.30 on the 60-minute chart. It's a little more granular, and $26.40 for the support. We are trading above the bearish resistance. We did violate that, but you can see that with a new signal. But we've also had quite a bit of volatility. Right now, one active upside target to $37.10. So in the short term, at least on the 60-minute time frame, this is looking positive. One downside target to $25.80, but it is not activated yet. The actual futures, this is CLJ6 or J16. So this is NYMEX light sweet crude oil futures for April delivery. Rolled the contract recently. You can see this is a 15-minute on close chart, so much more granular. You can see where this has actually come down, and it's been testing around $28.80. That has to do with the difference between the continuous contracts that are actually manufactured from rolling the futures. This morning we were down here around $31 or so when the report printed, and then since then we've been climbing. Interesting considering that we put in a new all-time record of storage, but we are beginning to see production decline consistent with the reduced exploration and production activity. The market appears to be responding favorably to that data point. Dollar correlation, very important anytime we talk about light sweet crude oil because it is an internationally fungible dollar-denominated commodity. In the top pane, we have that continuous contract. Again, this goes back to the eSignal contract in the top pane for light sweet crude oil futures. The heavy green dash line in the second pane is the U.S. dollar index, trades on ICE. Then we take the all-time correlation between the two instruments. That's the heavy blue dash line, and not surprising, at a -80, it's a very strong inverse correlation over the life of these two instruments. Then for a change in the bottom pane, the heavy brown or burnt red line, this is the 65-day correlation. So this is much more short-term. And you can see that, as happens occasionally, crude oil in the short run over the last 65 days is trading in a positive correlation to the dollar index, actually at 50. And as we zoom in here, we can see as the dollar corrected in the early part of February, we had a decline in crude oil, and then as the dollar made its short intermediate bottom and began to climb back, crude oil has done similarly. So we'll keep an eye on that, but just understand that this relationship that we're presently seeing between the dollar and crude oil, while positive, is only a temporary state of affairs during the last 65 days, and we expect this to return back closer to its normal historical inverse correlation. The forward curve for NYMEX light sweet crude oil futures comes to us via Update as Energy feed. If we go back 5 days, not really a lot of change, and I think a lot of that just has to do with all the volatility. We really haven't changed much in the last 5 days, but the range we've traded in has been very wide, rather frustrating from a trader's perspective. ULS diesel, like we mentioned at the top of the report, a very large drawdown this week. That certainly helps with some of the pressure we've seen on these refined products. The seasonal comparison for ULS diesel, constructed similarly to what we do for NYMEX or for commercial crude oil. The one difference we make is the blue dash line is a 5-year average as opposed to a 10 that we use for crude oil, and we've got a 34 million barrel surplus in ULS diesel. Seasonality for diesel very much mirrors what we see in crude oil, although we are the seasonal strength ends or begins to flatten out much sooner for ULS diesel. We'll be coming to the end of that shortly. The daily cloud chart for ULS diesel. This comes to you via e-signal. A very similar story to what we see in crude oil. No surprise there. The price line, the candlestick chart, the heavy blue lagging line, all well below the cloud. The cloud spans are negative. And this is one difference here is we do have the turning line above the standard line and the price just moving around the turning line, but not a lot to be bullish about here. Go to the hit Shift T and go to the 1% 3-box reversal chart on your point and figure. Again, well below bearish resistance. That's consistent with what we see on that daily cloud chart. One thing that's interesting here on the auto counts is we have no downside counts available right now. We have 2 active upside counts, one to $1.25 and one to $1.29. So we'll keep an eye on that. Still far too early to call any kind of a trend change, but in the short term, there may be some upside available in the ULS diesel. The 60-minute chart, this is a 60-minute point and figure chart. It's a 3-box reversal chart. Something to keep an eye on here. We did violate this bearish resistance. We gave a new buy signal above it, so we changed to bullish support, but we've pretty much retreated ever since then. Now, we may be finding some support down here in the vicinity of this bullish support line, but we do appear to have this overhead resistance at $1.11, at least on the short term. 2 active targets to the downside. The first one we're looking for is 87 cents and then possibly down all the way to 82 cents, and 1 active upside target to $1.32. So yes, we are trading above bullish support, but there's not a lot of confidence, and we still have a lot of work to do to move above that $1.11 and really assert a positive trend in ULS diesel. And it's hard to imagine that happening in the near term with seasonal strength coming to an end. Over to the actual futures. This is the 15-minute close chart for HOJ6. This is April delivery for ULS diesel. Very similar to crude oil. Not long after the report, had been trading around $1.03. We're up to $1.06. 1-to-1 crack spread. This is just a calculation, a very gross calculation between the value of the refined product as represented by ULS diesel futures and the value of the crude oil input determined by the price of NYMEX light sweet crude oil futures. So this is would be roughly a gross profit approximation for refiners. Down at $12.11. In 2015 we were up here around 20, and as those refined products have continued to build inventory, we've seen this spread compress. The forward curve for ULS diesel, if we go back and look 5 days ago, the curve has actually gotten a little bit steeper. So you can see we're down here in the near term, but we are actually growing above the where we were 5 days ago. So this is getting steeper and possibly indicating a little more bullish scenario for ULS diesel. Gasoline, we've been talking about this a lot after 8 weeks of inventory build, setting an all-time record. We have a good-sized drawdown, slightly over 2 million barrels this week. We mentioned that at the top of the report. Clearly, the drawdown in gasoline and ULS diesel helps the situation with total petroleum storage. The seasonal comparison chart for gasoline, we go back to a construction more consistent with commercial crude oil for this, in that light blue dashed line now represents a 10-year average as opposed to a 5-year average on diesel. However, we are still well stocked with gasoline, with just over a 27.5 million barrel surplus denoted there in the bottom pane. Seasonality for gasoline looks a lot like WTI and ULS diesel. We get this one last sharp spike in the coming days, and then really out of that we expect to move sideways. So what seasonal strength we've had available to us is going to begin falling away. We need to be aware of that, especially with the record storage. Daily cloud chart for gasoline, not anything different than what we saw in the two previous charts. Price and lagging line well below the cloud, negative cloud spans, turning line below the standard line, so still a very bearish picture on a daily basis on the cloud chart. Shift T goes to our 3-box reversal. Same story, well below bearish resistance. A lot of intermediate downtrends also weighing on gasoline, and then we've got two downside targets active to 65 cents and 62 cents, and one upside target to $1.38. But important to recognize that it's not active, and neither is that 62-cent target. Apologies about that. So 65-cent active downside, and then two inactive targets we'll keep an eye on. The 60-minute chart for gasoline. Not a lot that's very different there. Still well below bearish resistance. This downside target was realized. We can change that to black. Just kind of give you some nice visual representation, especially if you share your charts with anybody. We violated that bearish resistance line, but still below bearish resistance here. This downside target becomes active. So a lot of downside targets, a couple of upside targets we could put on here that were realized, and then possibly some others that aren't active, but still below bearish resistance. A lot of downside targets, 85 cents, 76, 73, 69 cents. A lot of downside targets from all these thrusts, and that is consistent with the record storage levels in gasoline. There's just not going to be any perceived shortage of gasoline, so there won't be much support for prices. The 15-minute chart, this shows the futures. This is gasoline for April delivery. We were in this tight consolidation down here this morning. We got the report, and we've been trending steadily higher along with crude oil and diesel this morning. Actually, we're in equity markets, even though we're down 150 on Dow futures right now. Earlier, that was down over 250, so we've seen some support come into the market, both in energy and equities. Intuitively, when we look at the crack spread for gasoline, 1-to-1 crack spread, constructed the exact same way via formula and update analytics. Very easy to do. If you have questions, email me or the technical support team on how to do that. You can see that I've highlighted here the $30 range and the $7.50 range that rarely do we trade outside of that the last 3 years. One thing that's a big difference this year is when you look at 2014, as you go through the springtime, same thing in 2015, we tend to climb up here to the upper part of this range, and this year we've just fallen off, and that is a direct result of that record gasoline storage. And then if we go and look at the forward curve for gasoline, go back here. A bit of a slow response this morning, but I don't expect much change in gasoline any different than what we've seen in ULS diesel or NYMEX, or the NYMEX light sweet crude oil forward curve. This is Brent with Black Lion Capital Management and the U.S. Petroleum Report for Wednesday, February 24th, 2015, featuring update analytics. If you have questions or comments, please feel free to contact me directly, or if you'd like to learn more about update analytics and the update energy feed, please contact their sales team directly. Thank you, and have a good day.